G'day Gain Squad, it is so good to have you back here at Goldie Gains for our midweek session. Let's see where the smart money is flowing today as we kick off the 1st of April 2026. Today we are unpacking a massive rotation in the markets and the latest tech sector layoffs rattling the cage. We are deep diving into the drama between Donald Trump and Keir Starmer over the Strait of Hormuz oil blockade. Plus, we will see if the AI bubble is finally popping and what that means for your gold and copper holdings. Just a quick reminder, traders, this is for entertainment and my personal market views, not formal financial advice. So, here is the big question for the comments. Is this tech sell-off the end of the AI hype cycle? Or is the market just having a bit of a wobbler before another massive leg up for the Magnificent Seven? Before we get into the charts, be a total champ and hit that like button and subscribe to the channel. Drop your price predictions below, because I love seeing where you smart money thinkers are positioning yourselves. Let's talk tech, because the industry has been flat out dealing with a fresh wave of job cuts this week. Goldman Sachs is set to begin cutting low-performing staff this April, which has put the finance and tech world on edge. Even the crypto space is feeling the heat, with Crypto.com cutting 12% of its workforce due to AI integration. HSBC is also weighing up to 20,000 job cuts as AI reshapes their entire global operations and efficiency. This is a massive shift, showing that the AI boom is starting to cannibalise the traditional white-collar workforce in Sydney. The Magnificent Seven tech stocks are starting to diverge big time as we close out the first quarter of the year. Apple and Tesla are stuck in a proper downtrend, while the AI darlings like Nvidia are fighting to hold support. On March 31st, Google released an algorithm called TurboQuant that claims to make AI 6 times more memory efficient. This triggered an absolute bloodbath for memory chip manufacturers like Micron, which fell 15.5% in a single week. SanDisk also declined 13%, as traders feared we would need fewer chips if the software gets that much better. This efficiency shock has led to a death cross on the US tech 1 to 100 daily chart, which is a major worry. When tech starts to wobble like this, the gold getters usually start looking for a safe place to park their capital. The S&P 500 fell nearly 6% in March, its worst month since 2025, leaving many feeling quite rattled. We are seeing a rotation into value and quality as the speculative AI bubble shows signs of some serious stretching. Now, let's pivot to the absolute chaos happening in the energy markets over the last 72 hours. West Texas Intermediate Oil, or WTI, is back on a tear, pushing over $100 a barrel this morning. The OVX, which is the fear index for oil, has exploded to levels over 100, which is just mental. An OVX at 100 means the market is pricing in daily price swings of up to 4.5%. This energy volatility is a textbook example of the oil shock paradox that has been capping gold's recent gains. High oil prices lead to sticky inflation, which stops the Federal Reserve from cutting interest rates as we hoped. Without rate cuts, the US dollar stays strong, making it harder for gold to blast off into the stratosphere. The Aussie dollar pair hit a 2-month low near 0.6865, making our local imports heaps more expensive. But the real drama isn't just in the prices, it is the geopolitical firestorm between Washington and London. On March 31st, a Kuwaiti oil tanker, called the Al Salmi, was hit and set on fire off the Dubai coast. This attack proved that the Strait of Hormuz is still a total no-go zone for about 20% of global oil. President Trump hasn't held back on Truth Social, taking some massive swipes at the UK Prime Minister, Keir Starmer. Trump basically told the UK they need to get your own oil and start fighting for themselves in the Gulf. He's furious that the UK refused to join the initial offensive strikes against Iran back in February and March. Trump wrote that the USA won't be there to help anymore, telling Starmer to build up some delayed courage. He even suggested that the UK should just go to the Strait and take it if they want their fuel back. Prime Minister Starmer has been telling the British public to act as normal, which is a tough ask right now. The UK government claims they have a resilient supply, but farming groups are already warning of food shortages. Trump's Defence Secretary, Pete Hegseth, also mocked the UK, asking where the big bad Royal Navy has gone. This rift between the US and the UK is making the markets very uneasy about the future of global security. If Trump actually pulls out of the war without reopening the strait, we could see oil go to the moon. Goldman Sachs thinks WTI could hit its 2008 record of $147 if this continues. Here in Australia, the RBA minutes from March 31st show that our policymakers are getting very nervous about inflation. They warn that if oil stays near $100, our inflation could hit 5% in the second quarter. That means more rate hikes could be on the cards for us Aussies, which is a massive headache for mortgage holders. The ASX 200 managed a tiny bounce of 0.25% on Tuesday, but it's been a grisly month. Our local index is down nearly 8% for March, which is the worst performance we have seen since 2022. But check this out. Some Chinese-owned ships actually managed to transit the Strait of Hormuz on Tuesday without being hit. Iran is letting neutral countries through, which is shifting the power balance away from the West and toward Beijing. This is adding fuel to the de-dollarization narrative as countries look for alternatives to the US-led financial system. However, demand for actual US dollars remains sky high because there is simply no other liquid alternative for now. The US dollar index, or DXY, is holding above the 100 mark, proving it's still the king of the mountain. Let's look at Dr. Copper, because the red metal is telling us a very interesting story about the AI trade. Copper is trading near $12,000 per tonne on the London Metals Exchange, which is a massive level. Data centres for AI need huge amounts of copper for wiring and power, which is keeping demand at record levels. The copper to gold ratio is at 50-year lows, suggesting that the industrial metal is outperforming the safe haven. This tells me that the smart money is still betting on structural AI growth, even if the tech stocks are messy. But the high energy costs are making it more expensive to mine this copper, with diesel machinery costs through the roof. If copper breaks above 13,000, it might signal that a broader industrial recovery is finally taking hold globally. For now, the market is caught in a tug-of-war between AI efficiency and the raw reality of energy constraints. Trump has given Iran a 10-day cooling-off period to reach a deal, and that timer is ticking down fast. If no deal is reached, he has threatened to blow up Iranian power plants and oil hubs like Karg Island. That kind of escalation would be a proper golden entry for anyone holding long positions in precious metals. On March 30th, gold futures opened at $4,520 and have been grinding higher. By April 1st, we have seen spot gold push back toward $4,600 as safe haven demand returns. It seems the market is finally realising that this geopolitical tension isn't just going to vanish into thin air. The smart money is using these dips to accumulate, especially with central banks still buying 60 tonnes a month. Wall Street targets for gold are still incredibly bullish, with some analysts looking for $6,000 by year-end. Even if the Fed stays hawkish, the fear of sovereign reserves being frozen is driving countries to buy bullion. The de-dollarization theme might be a bit of a bull market fabrication, but the central bank demand is fair dinkum. Let's optimise this entry by looking at how the tech-led sell-off is providing a rotation into hard assets. Tech is the most energy-intensive sector, so a permanent oil shock is a massive valuation headwind for the Nasdaq. Gold, on the other hand, doesn't have an electricity bill, making it a much cleaner play in a stagflation regime. The market's having a bit of a wobbler, because it's trying to price in a world with $100 oil. We saw a relief rally on March 31st as some traders hoped for a de-escalation, but it felt a bit hollow. Most bounces lately have looked like short covering rather than aggressive new buying from the institutional desks. Traders on the r/stocks forum are saying this sell-off feels different, with bad news finally being respected again. Earlier this year, every dip was bought instantly. But now the market is actually stopping to think about the risks. Trump's threats toward the BRICS nations regarding tariffs are also keeping the de-dollarization trend in check. He promised 100% tariffs for any country that tries to move away from the mighty US dollar. This is creating a scarcity premium for the greenback, which is why your gold gains have been a bit slower. But don't let that distract you from the long-term structural shift that is happening in global reserve management. The search for assets that sit outside any government's balance sheet is the primary driver for this gold cycle. Whether it's Trump or Starmer, The trust in the old Western financial architecture is clearly being tested right now. In Sydney, the cost of living is already through the roof, and these fuel prices are only going to make it worse. If the RBA follows through with more hikes, we could see a proper slowdown in our domestic retail spending. That makes high-quality gold miners like Northern Star look like a much safer bet than the average retail stock. Northern Star rose 4% on Tuesday, showing that the miners are starting to leverage the higher gold price. They are proper cash cows at $4,600, even if their diesel costs have gone up a bit. Keep an eye on the AUD price of gold, because that is where the real gains are for us Aussie gold getters. If the US dollar stays strong and the Aussie dollar stays weak, our local gold price could hit record highs soon. It's all about finding that edge in a market that is increasingly noisy and structurally fragmented across the globe. I'm personally looking at the copper to gold ratio as a signal for when to switch back into growth-oriented plays. For now, I'm keeping my focus on the defensive assets until the Strait of Hormuz situation finds some real clarity. Trump's potential exit from the war without securing the waterway is the biggest tail risk for the entire world. If he walks away and leaves the UK to deal with it, we could see a total collapse in maritime trade. Now, let's get technical and look at the charts to see if this is a proper golden entry for the squad. Gold futures on the 1-hour chart are flashing a strong buy signal as we move into the 1st of April. The Relative Strength Index, or RSI, for the 14-day period is currently sitting at a strong 71. This shows that the bulls have regained control of the momentum after that nasty slide we saw throughout March. On the daily chart, gold is navigating a Bollinger Squeeze, which usually leads to an explosive price breakout shortly. The price is oscillating right at the 20-day simple moving average, which is currently near $5,009. We are watching the 50-day moving average near $4,960 as a major technical ceiling. A confirmed close above that level would invalidate the bearish downtrend and open the path back to $5,000. Support is holding beautifully at the $4,405 inflection level we identified earlier. The MACD indicator is finally starting to narrow its histogram, suggesting the selling pressure is finally drying up. The ADX is at 45, which means this new upward move is actually backed by some very strong trend strength. Institutional volume profiles show that the point of control is sitting right around 4,473. As long as we hold above that POC, I'm feeling very constructive about the near-term path for our gold positions. If you are looking to optimize this entry, wait for a clean retest of the value area high near 4,300. To sum it all up, the market is currently a chaotic mix of tech layoffs, AI efficiency, and war drama. Tech stocks are struggling with a sector-specific shock, while energy prices are putting the squeeze on the global economy. Trump is playing hardball with his allies, telling the UK and France to secure their own oil from the Gulf. The Strait of Hormuz remains a massive choke point, keeping WTI oil elevated and the OVX index above 100. Gold is showing resilience, rebounding toward $4,600 as it finds its footing after a rough March. Copper remains the AI darling, but it's battling higher production costs thanks to the ongoing global energy crisis. The technicals are starting to turn bullish, with strong buy signals across the shorter timeframes as we enter April. So, what do you think, traders? Is Trump right to leave the UK to handle their own oil security in the Gulf? And will gold smash through $5,000 before the next Federal Reserve meeting comes around in June? Let me know your thoughts in the comments below, and please hit that like and subscribe button to help us grow. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!